This conference will now be recorded.
Good evening, folks, and welcome to another segment of the 4 pillars of a successful retirement. This is part 3 of 4 that we're going to be covering today, which basically amounts to tax planning. So with that, let's go ahead and get started. I'm your host for tonight. I'm Tom Doncaster. I'm an accredited investment fiduciary. I'd be more than happy to answer any questions you may have, either throughout this meeting or afterwards. If you'd like to write down our email address, it's Thomas Doncaster, ThomasDoncaster @msn.com. Or if you'd like to visit us on our website, that would be www.tomdoncaster.com. Let's go ahead and get started with tax planning, our favorite subject. So the overview that we're going to go over today is how tax rules could affect you and your family. Taxes can be quite a bit complicated, and you should always seek the advice of a qualified tax professional. And the focus on impact of federal income tax rules as they apply to you specifically. Now, the major tax legislation that has lasted now for 10 years started back in 2010 with the Small Business Jobs Acts of 2010, all the way on down through the Tax Cuts and Job Acts of 2017, which is what designated our new tax brackets, which are the lowest that I've ever seen. And in conjunction with that, we also have the Families First Coronavirus Response Act and the Coronavirus Aid, Relief, and Economic Security Act. So those are some of the things that we're going to discuss. Now, from 2018 to 2026, there will be some changes, obviously, for the business as well as for individuals. So if we take a look at the Secure Act that was enacted in December of 2019, most provisions effective on January 1st of 2020. One of the changes that it created was that it changed the required minimum distribution rules from age 70 and a half to age 72. So anyone born after July 1st of 1949 would be affected by these new rules. And that's primarily for tax qualified accounts, whether it would be an IRA, a 401k, 403b, or a 457 plan. It also eliminated age limitation for contributions to a traditional IRA. So now you can continue to contribute even beyond age 70. It also extended the 7.5% adjusted gross income threshold for deducting unreimbursed medical expenses for 2019 and 2020 tax years. It also provided an enhanceability of part-time workers, which mostly are age 21 and over, to contribute to a qualified retirement plan. And it eliminated the ability for most non-spouse beneficiaries of an inherited retirement account to stretch distributions over their lifetimes. So what that means is that anytime that there is a qualified account that is re-registered to anyone other than the immediate spouse, there is a brand new 10-year distribution rule. More on that a little bit later. Now, the Coronavirus Aid and Relief and Economic Security Act, that was enacted on March of 2020, just a little over a year ago. And most provisions expire at the end of 2020. It expanded unemployment benefits and offered tax relief to eligible businesses. It provided eligible taxpayers with a refundable income tax credit. Suspended the RMDs for last year, which they're not for 2021. And then it waived the 10% penalty for any coronavirus-related distributions up to $100,000 that might have been taken in 2020 from IRAs and other work-based retirement accounts. And it also temporarily increased the loan limit for employer-sponsored retirement to the lesser of $100,000 or 100% account balance. It also allowed outstanding employer plan loans with payments due between March 27th and December 31st of last year to be delayed by 1 year. And it also provided 6 months of automatic payment suspension for federal student loans. That helped quite a bit. So how will your retirement income be taxed? Well, Some of them are going to be taxed at ordinary income tax rates. Others will be capital gains, qualified dividends, income from IRAs, and employer-sponsored retirement plans are all taxed at ordinary income tax rates, since those do not have any type of cost basis. Other considerations in order to help minimize some of your taxes could be perhaps opening up some Roth accounts, do some Roth conversions on your qualified plans, perhaps consider some annuities, a health savings account if you can qualify for one, and possibly even maybe some tax-free municipal bonds. And with that comes net investment income tax as well as the alternate minimum tax, which we'll talk about that some more. So ordinary income, the way it works, it includes all your wages, interest, rents, royalties, business income, gambling winnings, and any taxable portion of your Social Security. And the reason for that is that if you pass over certain thresholds of income, half to anywhere as high as 85% of your Social Security could be taxable if you're not careful. And it's taxed on 7 marginal tax brackets determined by the taxable income. So marginal tax rates from 2017 all the way to 2025 are these that you see on the screen below. So the 10% is still in effect. The 15 dropped down to 12, the 25 to 22, 28% down to 24, and the 39.6 down to 37. However, they do sunset at the end of December of 2025, unless there's some kind of a revamp. But anyway, either case, the marginal tax rate on the next dollar of income tax is based on this particular slide that you see here for 2020. We also have one for 2021 that's being revised as we speak. So if you'd like to have one, give me a call. I'll be more than happy to email you one. And if you'll notice, there's a difference between single filers and married filing joint. You can see how the first 10% is taxed. One is just under 10,000 and the other one is pretty close to 20 grand. That's usually the big surprise that most people get when a couple reaches a point where one dies, and consequently the survivor is placed in a much, much higher tax bracket. So as an example, single tax filer with $50,000 of taxable income, last year, the first $9,875 would have been taxed at 10%. This year for 2021, it's $9,900. And then after that, $30,250 would be taxed at 12% of that 50 grand, and the remaining $9,875 at 22%, which basically means that that individual would be in an effective 13.6% tax rate. Pretty surprising, isn't it? In either case, one of the things that we've noticed over time is that the more money you make, obviously, the higher the taxable amount that you're going to be paying in to the U.S. Treasury. So keep that in mind and try to keep control of it as much as possible. These are some of the breakpoints that we've all are familiar with, maybe with the exception of the one that reaches the 25% tax bracket, which generally starts at a little over 326,000 on up. So long-term capital gains and qualified dividends, as most of you know, anything that is short-term capital gains, which is held generally for less than a year, is going to be taxed at ordinary income tax rates. Whereas anything held for more than 1 year, that is long-term capital gains, and they're taxed at special tax qualified rates. So they're pretty similar to long-term capital gains. Now, long-term capital gains, the tax reform either falls under no tax, 15% tax, or 20% that still apply. And that rate applies now depending on taxable income, not the tax bracket. Very important to note. So you may want to write that down. Long-term capital gains and qualified dividends. Well, as most of you know, single taxpayer, 48,000 or less, no tax. Married filing jointly, 80,000 or less, no tax. And then anything above that is going to be taxed at what? At a 10, 15, or 20% rate. Okay. So long-term capital gains and qualified dividends. Last year in 2020, the ordinary income tax rates versus capital gains, you can see on the slide where the difference comes in. So if you can, it's generally a good idea to hire an investment professional that'll help you with what we call tax harvesting. Take advantage of some of those tax qualified gains or qualified dividends whenever possible. So there's a big major difference there of ordinary income versus qualified dividends. Now, the additional 3.8% of net investment income tax basically applies to those that with much higher wages. So your modified adjusted gross has to exceed, as a single person, over 200,000, as a married filing joint 250,000, married filing separately 125 and above, and head of household is 200,000 or higher. Those are also important to remember because you'll have to pay that extra 3.8% investment income tax. Now, the AMT is something that all too often gets ignored, but it's becoming more and more of a gotcha. Most people out there will probably fall into that for 2021. And it has its own set of rules. So generally in the past, it's been anything above 120,000. So the Tax Cuts and Jobs Act increased AMT exemption amounts, and it phased out some thresholds. And it will affect far fewer individuals unless you happen to be making more than 120,000 of adjusted gross income. So as you can see in 2017, where the exemptions were versus where they were last year. Very important to keep up with that because this is what they call a catch-all tax. In the event that they can't get you with the other regular brackets, this is where they'll come after you. You make too much money, which I'm still trying to figure out how much too much is too much. But in either case, employer-sponsored retirement plans and IRAs, those distributions, as I mentioned earlier, are all taxed at ordinary income tax rates. And if you happen to take a distribution from those qualified accounts prior to the age of 59.5, you will be subject to an additional 10% penalty unless you have some kind of an exemption that applies, such as total and permanent disability. And by the way, before I forget, when it comes to qualified distributions out of a 401k, 403b, or 457, that penalty prior to age 59.5 is 20%, not 10%. So, as most of you already know, the required minimum distributions, the RMDs, are now at 72 instead of 70.5. So it gives us another, year and a half that we can postpone distribution from those qualified accounts. And special rules do apply to employer stock held qualified plans. I'll give you one of the exemptions that's out there. If you happen to have your 401k with your current employer, that you're listed as being a paid employee on the books, does not matter whether you're part-time, full-time, or anytime type employer. Just mentions that as long as you're listed as being on the payroll, you do not have to take an RMD if you're still working with that same company at 72, 73, 74. Now, once you do retire, that's when the RMDs start. Okay, so keep that in mind. That's an important, tax planning strategy. Roth IRA accounts. Well, their qualified distributions, as you know, are all tax-free from any kind of federal income tax. As a matter of fact, Roth IRAs happen to be one of 3 vehicles that also do not count towards the taxation of your Social Security benefits. Something else that you might write down because that's important. Now, when you do open one up from scratch, you must meet the 5-year holding requirements and one of the following. You have to be at least 59.5 or older, could be permanently and totally disabled. And if you're a first-time home buyer, you can, in essence, withdraw from the IRAs up to 10 grand without any penalties and without any kind of fees. Now, whether or not taxes are due, it all depends on how you withdraw. So, and there is no lifetime required minimum distributions from a Roth IRA. Now let's discuss annuities, and some of you might be familiar with them and most of you might not, because there's really 4 different types of annuities out there. Most people think there's only 1 or 2. The earnings portion of annuity withdrawals or payouts are taxed also at ordinary income tax rates. and the withdrawals are considered made from earnings first. So in other words, it uses the LIFO accounting principle. Last in is the first thing that comes out, which are your earnings, and you will get a 1099 for that, especially if it's a non-qualified annuity, meaning that it's not IRA 401k money that has funded it. There is also a 10% premature tax penalty on distributions prior to age 59 and a half, very similar to a traditional IRA. So the tax treatments can be a little bit complicated. Generally a good idea to consult with a professional. It's been around the block a few years, okay? So keep that in mind. Now the health savings account is something that all too often gets overlooked, and it has to be in conjunction with a high deductible health plan. So usually that means that you have to have a deductible of $2,400 or higher to be able to open up a health savings account. The pre-tax funds that are contributed grow on a tax-deferred basis, and any unused funds can roll over from year to year. So there is no set time frame that the money has to come out. Withdrawals are all going to be tax-free if they're used to pay for qualified medical expenses. So that would be things like deductibles that might not be covered, co-insurance perhaps, or something that maybe you might not have any coverage for, perhaps a dental, a vision, or some kind of a hearing type situation. And the funds to pay non-qualified expenses subject to tax and are subject to a 20% penalty, but that 20% penalty does not apply after the age of what? 65. Okay, tax-exempt bonds, municipal bonds, or munis, as some people refer to them, generally exempt from federal income tax. Income from treasury securities are exempt from state and local taxes, but not federal. Lots of caveats and special rules apply to those, so make sure you consult with a professional. Now, how are Social Security benefits taxed? Well, it depends on whether you're a single tax filer or a married joint tax filer. So as long as your modified adjusted gross income is under 25,000 as a single taxpayer, you don't pay any tax on your Social Security. Whereas if you're married, then that threshold is a little bit higher. It's anything under 32,000. And as you can see, once you exceed those thresholds of a single tax filer between 25 and 34,000, that's where half of their Social Security benefit payment will be brought back in and recalculated to be taxed. Once again, when you compare that to a married individual that's filing jointly, that threshold is a little bit higher, 32 to 44. And once you go over 34 or 44 for either being a single or a married tax filer, 85% of your Social Security will be brought back in and taxed all over again. So Social Security benefits, combined income. You take your adjusted gross, your tax exempt interest, 50% of your Social Security benefits, and that's what's considered to be your combined income. And that's what determines whether it's going to be 50 or 85% of your Social Security that will be taxed. What's not included are qualified Roth distributions. Remember, I mentioned that's one of three, and qualified health savings account distributions. Now, taxability of Social Security. Here's an example of two different couples, one that has a traditional IRA, one that has a Roth IRA. And as you can see, they have the same amount in CDs. They've received the same amount in dividend income from stocks, tax-free bond interest, the same. IRA income, they've each received 25 grand, except the difference is one is a traditional IRA and the other one's a Roth IRA. And then the Social Security benefit, 22,000. So the total amount of income is the same on each one. However, the taxable portion on that couple number one is much higher. Why is that? Well, that's because of the types of income that they have coming in. So that requires them to claim 85% of your Social Security as being taxable again. Whereas the second couple on the right there, they can only, in essence, have to report 31 that is considered to be taxable, and they don't pay any tax on their Social Security benefits. Isn't that fantastic? But that brings a tear to your eye, doesn't it? Lots of ways of structuring it, so keep that in mind. So the taxability of Social Security, the way that it works, it also applies to if you're taking out Social Security benefits early. So the way that it works is on this screen right here. AGI, adjusted gross income, plus half your Social Security. And if you're over 25 or 32 as a single or married individual, right? For every $1 in taxable income, 50 cents in Social Security is taxed. And that's a 10% marginal tax bracket. Whereas when you exceed the 25 or 32 and you're under the 34 or 44,000, then what? It's more like a 12% marginal tax bracket, which means 85 cents for every dollar of your Social Security is going to be brought back in. So in essence, the effective tax rate could very well go from 15 to what? 22.2. Something to really take a close look at. Taxability of Social Security benefits, they're going to vary. That's the marginal income tax rate that's in the light green versus the factoring in of taxation of Social Security benefits would be on that dark green line. And for every dollar in income, 50 cents in Social Security benefits are taxable. And then when you reach above that 25 grand as a single taxpayer, it's 85%, right? And then there's that higher portion right there that could give you a much, much higher tax liability. So there's greater flexibility planning in income with larger importance, with a larger emphasis placed on tax factors. So some of the things you might want to consider is when you should begin claiming your Social Security. We happen to have a software program that does about 310 different calculations, and it comes back with the top 3 or 4 best ages to start. It also takes into account what the survivor benefit is going to be, because as most of you know, like a pension, it could very well drop. So, and the source and timing of retirement withdrawals is also very important to, in essence, coordinate that with your Social Security and what the future impact is going to be coming from RMDs. That is generally 9 times out of 10 where most people wind up getting snagged. Now, the Tax Cuts and Jobs Acts and other changes that came about because of that, as you know, changed the personal exemptions from $6,500 per person to last year was $12,400. This year for 2021 is now $12,550. It also eliminated like child deductions or child credits and other changes like charitable contributions. So, and the reason for that is because of how they increase the standard deduction from $6,500 to now for this year, $12,550. So the big question is, should you use the standard deductions or should you do the long form and itemized deductions? Well, I guess it all depends. Your standard deduction amount nearly doubled for a joint married couple, right? It's about 25 grand this year. Additional standard deduction amounts, if you're 65 and older or you're blind, you get an extra what? $1,300 per person, right? And then deductions for personal exemptions, 4,050 in 2017, as you know, were eliminated. So can't count on that. So a lot keeps changing, and it's important for you to, in essence, stay abreast with these changes, or once again, hire a professional to help you, whether that be a CPA, a tax attorney, or even an accredited investment fiduciary like myself. Now, standard deduction and personal exemptions in 2017 look like this right there, whereas in 2020 last year look more like what? 24.8, right? Because last year was what? 12,400, and for 2021 it's what? 12,550. So it's going to be a tiny bit over 25 grand for this year. Now, itemized deductions, there's no limit on itemized deductions for high income filers. The adjusted gross income threshold for qualified medical and dental expenses from 2017 through 2020 was 7.5. This year, it's going to be 10%. And the deductibility cap for charitable contributions is also something else that's been factored in as well. Itemized deductions eliminated or substantially reduced certain miscellaneous itemized deductions, and casualty, theft, loss deductions were also curtailed, right? Itemized deductions for home mortgage interest And before the before the Tax Cuts and Jobs Act, up to 1 million in acquisition debt was deductible. Qualified residence, which was your principal residence or second income. Up to 100,000 in home equity debt was deductible. After the Tax Act, now that's not a million anymore. It's more like 750,000 in acquisition debt deductible. Qualified residence, which is your primary residence or a second home, and home equity debt not deductible. It's another one. So keep that in mind. Itemized deductions for state and local taxes, which is referred to as SALT. This is what it was before, what it is now. So as far as state and local taxes, cannot claim more than 10 grand. Before it was unlimited. Individuals can elect to deduct state, but it's still subject to what? 10,000 limit. And foreign real property tax may not be deducted. Sorry for those of you that might have a home in Italy or France or even UK, can't deduct that anymore. So now, standard deduction versus itemized deductions. These are the standard deductions that have increased, whereas the limits on home mortgage and state and local taxes have gone down for 2020 and 2021. So Roth IRA recharacterizations, right? Can no longer undo a Roth IRA conversion to recharacterize. That ended last year. So keep that in mind. Now, other changes that are worth noting is the Affordable Care Act of individual responsibility payments, which was repealed as of 2019. Federal estate and gift tax exclusion amount doubled to 11.18 million in 2018, and it reached 11.58 million in 2020. Now, for some of you, it might not fall into that category, but you might fall under the one for the Washington state death tax. That starts at 2.2 million. So anything above that, they're going to come after anywhere from 10 to 20% tax when both you and your wife are no longer here. So that means the kids are going to have to pay it out of your estate. Alimony is not deductible anymore by the paying spouse. So keep that in mind. And moving expenses, deduction for a job-related move has been suspended through 2025, except for members of the armed services on active duty. Other changes worth noting, 529 Plan Enhancement. This is a big one. Expanded to include K through 12 tuition expenses up to $10,000 annually. So if you want to send your children to private school, guess what? You can use some of that 529 plan money. It doesn't have to be for college or technical school. It can be for K through 12. And rollovers to an ABLE account are going to expire after 2025. So keep that in mind. By the way, if you're a business owner, pass-through business income deduction, 20% of qualified business income is also something worth noting. First year bonus depreciation is another item. The Internal Revenue Service Code, IRC, section 179 expensing is another thing that was changed as well, which generally involves insurance. So we're going to stop now and take a break. If you have any questions, I'm going to give you my telephone number if you'd like to give us a call. That's area code 509-735-9518. I'm generally in on Tuesdays, Wednesdays, and Thursdays, but if you want to leave me a voicemail, I'll be more than happy to return your call. In addition to that, I also want to remind you that our email address is Thomas Doncaster, Thomas Doncaster, DONCASTER, all lowercase, run together, at msn.com. Got to keep Billy Gates in business, you know. All right, folks, thank you very much for taking time out of your busy schedule. Hopefully you learned something, and we will reconvene next Tuesday evening again, and we will cover legacy and estate planning, which applies, believe it or not, to everyone now. See you then.